The average Australian holding $50,000 in large-cap ASX stocks gets back 64% of their money in crashes. Switch to small-cap timing and you're back at 90% in roughly half the time. Same market. Same economy. One decision changes your outcome by $13,000 per recovery cycle. Your bank doesn't advertise this. They won't mention it when the market dips. They've got zero incentive to push you toward anything that shakes. They make money on volume and stability, not volatility and recovery timing. And look, that's not a conspiracy. That's just how fees work. A $50,000 large cap portfolio sitting still in their platform. They are happy. That's predictable revenue. A $50,000 small cap portfolio that moves 18% in a quarter and might need active rebalancing. That's work. That's variable. That costs them complexity. So they trained an entire generation of Australians to think small cap means risky and large cap means safe. And during corrections, when panic is running high, they've conditioned you to buy the thing that recovers slowest. By the time small caps are actually moving, you're already locked into your CBA at the worst possible price. Here's the actual data. The 2020 crash. Large cap stocks on the ASX took 22 months to fully recover. Small cap took 14 months. That's not theoretical. That's measurable. 8 months faster. In a $50,000 portfolio, that's the difference between being down $18,000 in month 20 or already being up $3,000 in month 14. One decision. 8 months of difference. Most people miss this because nobody's incentivized to tell them. The 2008 financial crisis. Large cap ASX recovery took 36 months. Small cap took 26 months. 10 months. On a $50,000 position, 10 months of difference in full recovery is 10 months you could have been reinvesting, or rebalancing, or just sleeping better knowing you're actually recovering instead of still underwater. Now, mistake 1. Everyone thinks small cap means individual stocks. It doesn't. You buy a small cap ETF. There's 5 solid ones on the ASX. VAS small cap holdings, SET, XSML, SFY, and AFI have small cap allocations. You're not picking ASX 200 penny dreadfuls. You're buying a diversified basket that tracks exactly the space that recovers 60% faster. Same company concentration you'd get in a large cap ETF, but positioned in the part of the market that actually bounces hardest when corrections end. $5,000 per month into a small cap ASX ETF at 6.5% average annual returns over 15 years becomes $1,347,000 instead of $1,186,000 if you'd stayed in large cap at 5.8% returns. That's $161,000 extra just from understanding that small cap doesn't mean individual stock picking. It means understanding where the recovery happens and positioning yourself there. Mistake 2. Timing. Everyone knows you are supposed to buy crashes. They've heard it. They believe it intellectually. And then the market drops 12% and they freeze. They don't act on the small cap bounce because they don't believe it's actually coming. They are waiting for the bottom. They are checking the news. They are seeing headlines about economic slowdown, and suddenly $5,000 per month into anything feels risky. Here's the actual move. During the last 3 major ASX corrections, small caps bottomed an average of 16 days before large caps did. Not 16 months. 16 days. If you're waiting for absolute bottom, you've already missed it by the time you see the all-clear signal. You buy small caps when they are down 22% to 25% from their peak. By the time large caps hit equivalent percentage losses, small caps are already recovering. That's the timing advantage. That's why the recovery is actually 60% faster. It literally starts faster. Mistake 3. Everyone sells too early. They see small caps bounce 8% in a fortnight, and they think the recovery is done. They lock in gains. They go back to large cap safety. And they miss the next 40% climb that happens over the following 6 months. A $50,000 investment in a small cap ETF purchased at March 2020 lows would have hit $97,000 by December 2021. If you sold at the 8% bounce in April thinking you'd locked in gains, you only made $4,000. You missed $47,000 because you didn't understand the recovery cycle. Small cap crashes are deeper, but the recovery is faster and longer. Sell too early and you're back in the thing that barely moves. The fix for timing is simple. Calculate your buy threshold. When small caps drop 20% from their 52-week high, you buy $5,000 per month for 3 months straight. Not timing the exact bottom. Just understanding the statistical likelihood that small cap recovery has started by that point. Over a 20-year career, you'll hit this threshold roughly 4 times. Each time you execute the same move, you're mathematically building wealth during the periods when most people are just protecting it. The fix for selling too early is a calendar. You don't sell small cap positions for minimum 18 months after purchase during a recovery. If you bought at a crash bottom, you've locked in the fast recovery. Selling inside 18 months means you're selling before most of the bounce has happened. That's the actual cost. Not missing the bottom. Missing the 20 months after it. Let's quantify what this actually adds up to. You've got $50,000. Market corrects 20%. You're down $10,000 like everyone else. Large cap recovery kicks off at month 22. You're back even at month 22. Small cap recovery kicks off at month 14. You're back even at month 14. But here's the actual kicker. Small caps don't just recover. They overshoot. They gain 15% above their pre-crash high during the rebound phase. By month 24, a small cap portfolio is at $57,500. A large cap portfolio is at $50,000. Same $50,000 starting point. Same market correction. Different recovery destination. $7,500 difference. Over one 20-year career, you'll hit corrections roughly 4 times. That's $30,000 in differential gains, just from understanding which asset class to hold during crashes. 24-hour action plan. Hour 1, open your bank's trading platform and check your current ASX holdings. Write down what percentage are in large cap names, what percentage would be classified as small cap. Most Australians find it's 85% large cap, 15% small cap or less. Hour 2, pick one of the 5 small cap ETFs I mentioned and read their fact sheet. Just 10 minutes. Understand what you're actually buying. These aren't penny stocks. These are diversified baskets. Hour 3, if your portfolio is less than 30% small cap, and you genuinely believe you'll stay invested through crashes, set a calendar reminder for the next 20% market correction. You'll know it when you see it. The news will be everywhere. That's your buy signal. When it happens, you move $5,000 per month from large cap into small cap for 3 months. You then don't check the position again for 18 months. You don't sell. You don't rebalance. You let the recovery compression play out. That's the move. That's literally the entire system. Your bank doesn't want you doing this because it creates work. It creates volatility they have to manage. But it works. The data proves it works. And you've got the time frame to use it. You're here watching this, which means you're not 70. You've got crashes coming. You're going to experience probably 4 or 5 significant corrections before you retire. Each one is an opportunity to build $7,500 to $12,000 in extra wealth just by understanding that small cap recovery is real and measurable and available to anyone with a brokerage account. That's the move your bank won't advertise. That's why we are telling you.